I'm Austin Schaul, Head of Research with Avantax. Today, we'll provide a market update for November. We'll start with a recap of returns for October, and then shift to a discussion around recent strength in the U.S. dollar, the Federal Reserve, valuations, and our outlook going forward. October brought a mixed bag of performance for global stocks, with stocks here in the U.S. outpacing their foreign counterparts. The S&P 500 was lower by about 0.9% in total return, while the Russell 2000 was lower by 1.4%. On the international front, the MSCI EAFE index fell by 5.4%, and the Emerging Markets Index lost about 4.3% after leading the way in September. Through October, all major indices remained firmly in positive territory for the year, as U.S. stocks continue to lead the way. The S&P 500 index is now higher by 21% on the year, while small-cap stocks are higher by more than 9.5%. On the international front, developed markets are now higher by more than 7.3%, and emerging markets are up about 12.2% year-to-date. The relative outperformance of U.S. stocks can in large part be attributed to recent strength in the U.S. dollar, which appreciated nearly 4% against a basket of global currencies during October. Foreign exchange rate fluctuations impact the performance of foreign stocks for U.S. investors, and the movement of exchange rates can either benefit or hurt U.S. investors who hold foreign stocks, particularly over the short term. With that said, the impact of currency fluctuations over longer time periods tend to be minimal, as highlighted in this next chart, which shows the annual return difference between the returns of international stocks in U.S. dollars versus foreign currencies. As you can see, foreign currency exposure helps in some years and hurts in others, but over time, it is effectively a wash. The past month proved to be quite challenging for bond investors as interest rates moved notably higher over the course of October. The taxable bond index fell about 2.5% in October, while municipal bonds lost about 1.5%. For the year, both indices remain in positive territory, with taxable bonds higher by about 1.9%, while municipal bonds are higher by about 0.8%. As we have emphasized in the past, Federal Reserve policy continues to be a key driver for the markets. Despite the Fed's 50 basis point rate cut in September, Treasury yields marched higher throughout the month. After starting October around 3.74%, the yield on the 10-year Treasury finished the month trading around 4.25%. Though the economy is showing signs of slowing, economic data remains relatively strong, and inflation is still running above the Fed's 2% target. For the markets, this means that the Fed is likely to be more cautious about cutting interest rates too quickly. Looking forward, the futures markets are pricing in one 25 basis point rate cut at each of the Fed's two remaining meetings this year, which will take place in early November and late December, which would leave the upper end of the Fed funds rate around 4.5% by year end. As we approach the final months of 2024, equity markets around the world continue to trade near all-time highs, and valuations remain elevated relative to historical averages. As this final chart shows, the S&P 500 currently trades at a forward price-to-earnings ratio of nearly 22, well above the 30-year average of about 17. With that said, it is important to note that the composition of the U.S. equity market has changed drastically over the past several years. Certain sectors, such as technology, tend to command higher multiples due to stronger earnings growth and profit margins. Looking back to 2010, the technology sector accounted for just 12% of the S&P 500's market cap. Fast forward to today, technology stocks make up nearly one-third of the index. In short, even though stocks don't necessarily look cheap right now, higher valuations can in part be explained by the changing composition of the U.S. stock market, which continues to trend more towards higher multiple growth stocks. So, that's what we have for this month. Thank you for watching and have a great day.